So we have talked about in other videos how to set up your S-Corp salary to maximize tax savings without overpaying payroll taxes. That video is about optimization. This video is about something different. This is about defense. Because there's a specific way the IRS looks at S-Corp returns. There are specific patterns they flag, specific documentation they demand when they come in, and specific behaviors that draw their attention in the first place. Most S-Corp owners don't know exactly what those are, and that puts them in a reactive position if they ever do get a notice. I want to change that. I'm Matt Losanno with Cinder Wealth. In this video, we're going to walk through the S-Corp audit red flags the IRS is actually looking for in 2026 and what you can do to be ready before a letter ever arrives. Quick disclaimer, this video is for educational purposes only. It's not legal or tax advice. Audit risk is specific to your situation. Always work with your CPA and tax attorney on compliance matters. Let's start with why S-Corps draw IRS attention in the first place. The S-Corp structure is legitimate and widely used, but it also has a well-known tax advantage. Owner-operators can split their income between salary and owner distributions, paying payroll taxes on only the salary portion. The IRS knows this. They know every S-Corp owner has an incentive to keep salary low, so they watch for it. The IRS has publicly identified S-Corps with officer compensation issues as a compliance priority for several years running. The IRS uses internal data and benchmarking to evaluate whether compensation appears reasonable. When your return comes in significantly below those benchmarks, it gets attention. They also have data matching. If your K-1 shows you taking $400,000 in distributions, but your W-2 from the S-Corp shows a $40,000 salary, that discrepancy can increase audit risk and may be flagged through IRS data matching before a human ever even looks at the return. And here's the thing, many S-Corp audits are targeted examinations focused on specific compliance issues. They come in with a specific checklist and they know exactly what they are looking for. Being unprepared is expensive, not just in potential back taxes and penalties, but in the time and professional fees it takes to respond. The best position to be in is one where the documentation was built proactively, not assembled in response to a notice. Red flag number 1, officer compensation that is unreasonably low relative to distributions. This is the top trigger, and it's the one the IRS has the most data on. The standard is reasonable compensation. What would you have to pay someone else to do what you do in your business? The IRS looks at a set of factors: your industry, your qualifications, the size and complexity of the business, the hours you work, and what comparable positions pay in your area. So, when your salary is a small fraction of total distributions, the IRS will scrutinize whether the compensation reflects your actual contribution to the business. What you need to have documented: a written compensation analysis. This doesn't have to be a formal appraisal, but it should show how you arrived at your salary number. Reference comparable job postings, industry surveys, or a formal reasonable compensation report from a qualified professional. Consistent payroll records. Your W-2 should match your payroll records. No gaps, no ad hoc adjustments at year end that look like you are reclassifying income after the fact. Minutes or notes supporting the salary decisions. So if you have a formal board meeting or even a written officer resolution where the salary was approved, that documentation matters. Red flag number 2, personal expenses running through the business. This is one of the most common areas the IRS challenges in an audit and one of the most avoidable. Business deductions need to be ordinary and necessary expenses of the business. Meals, travel, vehicle use, home office, cell phones, all of these are legitimate business expenses in the right context. But all of them become red flags when they are clearly personal. So what draws the IRS attention? Vehicle expenses with no mileage log. If you are deducting a vehicle but you can't produce a mileage log showing business use, you're exposed. Meals and entertainment that are disproportionate to the type of business you run, like a solo consultant with $50,000 in annual meal deductions is going to get a second look. Home office deductions where the space is not used regularly and exclusively for business. This is a bright line rule, not mostly business, exclusively business. Personal travel mixed with business travel where the business purpose is not documented. Most audits don't start because someone did something illegal. They start because something looks inconsistent. And here's the practical fix. Document everything in real time, not a tax prep time. Mileage logs, meeting notes tied to meals, calendar entries for travel. The documentation you create when the expense happens is infinitely more credible than documentation you construct at year end. Red flag number 3, inconsistent or missing payroll records. This one surprises a lot of S-Corp owners. If you elected S-Corp status but are not running proper payroll for reasonable compensation, that's a significant compliance issue. The salary has to flow through a formal process or payroll system with proper withholdings, W-2 issuance, and employment tax deposits. Ad hoc transfers from the business account to your personal account, even if you call them salary, do not satisfy the requirement. The IRS looks at whether payroll tax deposits were made on time, whether the W-2 matches the payroll records, and whether the timing of compensation is consistent across the year. Red flags in this area: a W-2 that shows compensation only in the fourth quarter. This looks like reclassification where distributions were moved into salary at year end for tax purposes. Payroll tax deposits that don't match the reported W-2 wages. No formal payroll system. Handling payroll yourself through informal transfers dramatically increases your audit exposure. So, what does being audit ready actually look like? Here's a practical checklist. 1. You have a written compensation analysis on file that justifies your officer's salary, updated whenever your income, role, or business significantly changes. 2. Your payroll records are clean, consistent throughout the year, handled through a formal system. 3. Business expenses have documentation, mileage logs, receipts, meeting notes tied to meal deductions. 4. Your personal and business finances are completely separate. Dedicated business bank account, dedicated business credit card, no personal expenses flowing through the business without a clear business purpose. And 5. Your CPA has reviewed your return with S-Corp compliance in mind, not just whether it was filed correctly. 6. Your financial advisor understands how you're compensated, not because they file it, because how you're compensated affects your retirement planning and your overall wealth plan. They should know how you're set up. And as always, the last point is the coordination piece. Your CPA handles compliance, but if your financial advisor doesn't know how you're compensated and your attorney hasn't reviewed your operating agreement since you made the S-Corp election, you have some gaps that show up in the worst possible timing. So here's the summary. The 3 biggest S-Corp audit red flags are unreasonably low officer compensation relative to distributions, personal expenses flowing through the business without proper documentation, and inconsistent or missing payroll records. All 3 are largely avoidable with proper planning and documentation, not reactive scrambling after a notice arrives. The best audit defense is a clean, consistent, well-documented record that you built intentionally, not a stack of receipts you dug out of the drawer 3 years later. If you are not sure whether your current setup is audit ready, that's a conversation worth having with your CPA before the end of this year. Subscribe for more content on tax strategy, business structure for business owners. Again, this video is for educational purposes only. It's not legal or tax advice. Audit risk and compliance requirements are specific to your situation. Always work with your CPA and attorney. Thanks for watching.